They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit rating to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have
Hi everyone. Thanks for joining us. In the meantime, as we wait for the rest of the people to come, we have some coffee, refreshments outside. Feel free to have some kindly.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
Hi everyone, let's please take our seats. We should be starting in the next few minutes. We have a whole lot of online that are waiting for the program to begin. In the meantime, I'll ask the production crew to just play the remarks from the presidents as we get the people outside to come in. Thank you.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
Divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
We are going to rework the whole credit rating system because the current one is all or nothing. You're in or out. And we have 15 million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
The divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.
Thank you, producer. We're actually live. That's why you see him counting down. Hi, everyone. Okay. Hi, everyone. I know there's been so much traffic, and we're so grateful that you made it. I wish we had some bypasses, I don't know where, but thanks for making the time. Distinguished guests, ladies and gentlemen, our attendees joining us from all around the world, good morning, good afternoon, good evening. My name is Maggie Umotesi, and I'll be your host today. I'd like for you to get used to me because I'll be here for the next 2 hours. And it's my absolute pleasure to be hosting this conversation. This event is co-hosted by Africa Catalyst's Global Development Advisory Firm, based in Dakar and operating across Africa in partnership with UNDP Africa. And today we'll be focusing on the conversation on developing credit rating solutions for Africa's financial needs. Now, there's so much to unpack, but I know that in the interest of time, we have to move faster so that we get into the panel discussion. Before we kick off the program, I want to put down some house rules. We are streaming live on the Africa Catalyst social pages. I also want to say UNDP, but producer, correct me if I'm wrong or if we're not live yet, are we? Yes. So we are live in case you're not able to join us in the room. And we're using the hashtag Africa Credit Ratings. If you use that, we'll be able to take your questions, comments, and any feedback you might have for us and the panelists. At this particular point, I would like to ask you to join me in welcoming the UNDP resident representative for Kenya, Anthony Ngororano, to give us the opening remarks.
Good afternoon. We'll try again. Good afternoon. For those of you who are joining us in Kenya, Karibu, Kenya, my name is Anthony Ngororano. You're going to excuse my voice. It's been a very long few days. So it's really my pleasure on behalf of UNDP to welcome you all to this really exciting side event. I think this side event has obviously a backdrop with regards not just to the AFDB general meetings, but I think more broadly, you will all have heard the resounding clarion call by President Ruto around the need to reform the global financial architecture. And so I think in many ways this conversation is timely. The government of Kenya, who I'd like to salute, I know a number of representatives are here, along with others. We have been told, for good reason, are really excited and enthused to be really with us together at this critical juncture. So on to now this note. So really pleased to welcome you to this forum on developing credit rating solutions for Africa's financial needs. And allow me to really acknowledge both the Africa Catalyst team, but also the UNDP Africa team, a number of whom are joining us, I know, from New York and from across the world. The story of development in Africa, as you all know, has been one of mixed successes, with on one hand impressive infrastructural development, rising educational and human capital levels, and a massively expanding footprint in terms of the digital economy, and improved access on the whole in terms of access to basic services. That said, and Kenya is no exception, inequality remains a stubborn impediment to continued trajectories in terms of growth. In terms of numbers, as many of you will know, 20% of the population is still classified in the region as food insecure, and we do of course have the lagging both temporary but also permanent effects arising from the multiple shocks. I think in UNDP and amongst you we talk of the poly crisis that I think opens up a number of questions. Looking ahead, UNDP partnered with Standard & Poor's in 2003 to support African countries to pioneer credit ratings on the continent, leading to 32 countries being evaluated by 2023. As a result, African countries have accessed international financial markets and obtained sovereign bonds whose proceeds have mainly gone towards infrastructural development. The repayment terms of the bonds are dependent, as you all know, on global credit ratings conducted by a very limited pool of 3 agencies. Despite the ease of disbursement and fewer conditionalities, the sovereign bonds and their repayment stand at almost 8 times the rate for African countries compared to countries in the global north. This has led to calls for lowering the cost of financing, capitalizing of African continental financial institutions, and an increase in the continent's voice and representation in global financial institutions and decision-making forums to unlock the very needed additional resources for development. As a direct result, the UN Secretary General has called for a mobilization of an additional $500 billion for accelerated achievement of the Sustainable Development Goals, a sum that will prove vital if the Africa region is to achieve the goals by the 2030 deadline. It's expected that a significant amount is likely to be sourced through sovereign debt, given the role of governments as the single most important financier in development. However, as numerous countries in the region have now transited from the lower middle income category, both to the lower middle income category and from to upper middle income, this comes obviously at a higher cost and has significant implications given the reduction in the availability of concessional funding. In conclusion, in Kenya, policymakers continue at the very highest level to advocate for reforms of the international financial architecture, including in and around what brings us here today, that is the methodologies used by global rating agencies in assessing risks on the continent. There are a number of suggestions that the rating agencies have also made significant judgment errors in their assessments that impact and influence financing decisions around global capital flows. So, for example, mirroring the most recent financial crisis, credit ratings suggest that there could be a missing component in the rating methodology that we need to uncover sooner rather than later. Therefore, rating agencies and stakeholders need to begin deliberations on improving credit scoring, which would be a critical input in the reform of the global financial architecture, facilitating, or at least potentially facilitating, access to sustainable financial flows. Ladies and gentlemen, as I conclude, mine is not to preempt what I'm sure will be the rich discussions, but really to put once again into context the importance of this discussion given the changing tide on this. And so let me, in concluding, wish you all fruitful deliberations and once again thank you for being part of this important moment. Asanteni sana.
Thank you, Anthony. Now, as we move on with the rest of the program, we also have a video from the UN Assistant Secretary General and UNDP Regional Director for Africa, Ahona Zio-Konwa. I'd like for you all to turn your eyes to the screen and have a listen to her remarks, kindly.
Your Excellencies, distinguished guests, I am honored to address you today on this important topic. You know, credit ratings impact the development trajectories of African countries by defining the cost of development financing. They influence the extent to which development partners can actually support critical investments on the continent. Borrowing from capital markets to finance economic development is a necessity, and everyone is doing it. And especially as official development assistance flows to African countries have actually been shrinking in recent years. It is therefore imperative that we find a way to make credit rating fairer for all African countries. A 2023 UNDP report that we titled Lowering the Cost of Borrowing identified biases in credit rating methodologies, translating into higher borrowing costs for African countries. Our analysis shows that African countries could save up to $74.5 billion if credit ratings were based on less subjective assessments. This figure is actually more than 80% of Africa's annual infrastructure investment needs. That it's estimated at $93 billion. This not only constrains Africa's development spending, but also contributes to debt stress and macroeconomic instability. Many cash-strapped countries are put in a difficult position of having to choose between repaying debt and feeding their population. This report has laid the foundation for an informed action plan that will lead to a more inclusive and more responsible credit rating system for African countries. And so today, we are proud to launch the Africa Credit Ratings Initiative, which aims to strengthen the capacity of African countries to navigate that complex global credit rating systems effectively. Through a dedicated online platform for policymakers, a group of expert advisors, and a community of practice, our ambition is really to equip African countries with the necessary knowledge and tools that they need to navigate this complex world of credit ratings and address the current systemic biases and limited data issues. We're proud to partner with Dakar-based Africa Catalyst on this arduous but potentially transformative journey. Beginning with pilot countries like Kenya, Tanzania, and Uganda, this initiative will enhance transparency, improve ratings, and ultimately reduce the cost of borrowing for African nations. A series of workshops across these three countries will convene officials from the ministries of finance, of statistics offices, central banks, and other relevant authorities to enhance their knowledge and understanding of sovereign credit ratings from a development perspective. Our end goal is to lower the cost of borrowing for African countries. When we do that, we free up resources for critical development projects that will drive sustainable growth and prosperity across the continent and help us achieve the Sustainable Development Goals. For Kenya, Tanzania, and Uganda, this initiative could be quite transformative. Potentially, they could save up to $5.5 billion in excess interest payments and unrealized lending. So yes, the task is daunting, but with your support, we could help transform Africa's development landscape. And I want to close with an Ashanti proverb, which says, "Do not let what you cannot do tear from your hands what you can." It's a reminder for us to focus on what can be achieved rather than being discouraged by what cannot. So let's remain resilient, let's remain proactive and resistant to the business as usual approach. Thank you, Asante Sana, and I wish you all very fruitful discussions.
Thank you. Thank you, everyone. A round of applause. Okay. So I just want to remind everyone online and in the room that we have French translation. There are microphones in the seats, just in case you want to listen to this conversation in French. Also, to reiterate, we are live using hashtag Credit Ratings Africa. Just use that to send us your questions or comments, and we'll be able to pass them on to our panelists or get back to you. It's now time to jump into the panel. And I just want to say that this conversation is very timely. And we've had discussions in the past for a very long time. We can all agree. Last year, we had a panel discussion that looked at the impact of credit ratings on the development of African economies. The numbers were enormous. I don't want to reiterate that, but we jump into it with our panelists. And this year, today, we're taking a step further to look at the solutions, share best practices, experiences collectively, and see how we can support each other, governments, agencies, development institutions, how we can work together, basically, to help countries navigate their credit ratings. Having said that, I'm not going to answer the questions, I'm not the expert. I would like for you to have a look at this quick video that sets the tone for us and also gives us an idea as to why we really need to have this conversation. Producer, could you kindly help me put it up?
Since 2000, an increasing number of African countries have been issuing Eurobonds to finance parts of their development. This could include investments in infrastructure, technology, and energy. However, we're finding that the costs of those Eurobonds are usually really high, and those costs are linked to how African countries are rated. Credit ratings have become an important part of Africa's development financing landscape. This is why UNDP's Africa Bureau is partnering with AfriCatalysts to host a high-level panel on the 28th of May at the Pan-Pacific venue at GTC in Nairobi from 4 to 6 p.m. local time. This panel will interrogate some of the issues relating to credit ratings, their costs, and practical things that African countries must do to lower the cost of borrowing. Join us there to explore this important yet exciting dimension of development financing across the African continent. Thank you.
Thank you, Raymond. At the end of the day, we're talking development, we're talking people's livelihoods, but we have to start with complex conversations like this. As I call upon my panelists, I would like to ask the crew to help me pull up the virtual panelists. We have panelists joining us online, but in the meantime, I'd like to invite Hannah Ryder, who is the CEO of Development Reimagined, to join me on stage. Guy Dillon, the Managing Director, Head of Financial Services, Structured Finance and Governments, Europe, Middle East and Africa, S&P Global. Online we have Raymond, okay, let me start with what we have. Online we have Savishen Pillay, the Managing Director at Credit Ratings Analytics. And we have Raymond Jerpin, who is the Chief Economist at the Regional Bureau for Africa at UNDP. Thank you so much, all of you, for joining us this afternoon. So let's jump into the conversation, right? Okay. Thank you so much, Raymond, for joining us. Savage, thanks for joining us. I just want to do a quick check, considering this is tech. Can you hear me? Fantastic. Raymond, can you hear me? Yeah, we can hear you. Fantastic. So with that, I just really want to bring in Hannah to help me start off this conversation, obviously. We've heard from Ahuna, we've heard from Raymond giving insights. And at the end of credit ratings, you know, one thing that is constant is development, is progress, is financing. At this point, what are the things that agencies, or rather the things that development institutions like yours can do to really support governments and probably work collaboratively with agencies to help countries navigate the ratings?
Great, thank you very much for inviting me, first of all, to be part of this discussion. and also to, and Maggie, thank you for your question. Look, I think it's been quite clear from the presentation so far that this is the important context for any discussion about finance on the African continent has to be in the context of development. It has to be related. We cannot divorce it from what is needed for development. We cannot divorce it from the amount of finance that we need for development. And what we know is that financial needs are extremely high. We look at our infrastructure here in Kenya, it's improving, but there is so much further that it can go, and that's pretty much every single African country. None of us have got to where we would even like to be at this point. Why? Because of a lack of finance. And importantly, because in many cases, the finance that is available, including from the private sector, is very expensive. And let me explain a little bit about how that expense effectively trickles down. If you think about it, if countries are borrowing on the international markets and from the international institution, if governments are borrowing at an expensive rate, what then happens is that you then have commercial banks that are then borrowing from the government quite often, or other means. Their finance is going to be expensive, so you add on a few interest rate points. Then you come to other organizations that are borrowing from the banks, businesses, manufacturing, SMEs. They're borrowing, and that's going to be even more expensive. So when finance is expensive at the international level, by the time it gets to Mwananchi, it becomes extremely expensive. And that means people are locked out of financial markets, and it's a people issue. It's not just an issue here for governments. And I think that is an important perspective for, and why organizations like the UN, why organizations who are committed to development, we're a private sector organization, but we're committed to development, why we care about this issue and why we want to find solutions to it, because it has that impact on real people's lives.
Thank you. Guy, I just want to bring you in. Hearing Hannah speak, we're talking about interest rates and the cost of borrowing being high. Talk to us about the methodology used, considering that countries have evolved development-wise. Let's say country A has a political crisis. How do you factor that in? Has this changed? What conversations are happening around that?
Sure. So, first of all, thank you for giving us the opportunity to be here today, because that clearly gives us, the possibility to demystify, in a way, what credit ratings are about. And I think this is not exactly well understood by within some circles, essentially, and I think it's quite important for us to explain to you how do we work, right, and what do we want to achieve. So your question about methodology is that's a fair question, and I'm going to get to it in a second, but I would like to start by saying that credit ratings fundamentally are an indicator that provide an assessment about the willingness and the capacity of a debt issuers to meet its financial obligations. Willingness and capacity. And you've got two components there, right? Willingness, it doesn't happen too often in a way when you've got some kind of crisis, but it's an ongoing evaluation of financial policies which are aimed at putting the issuers in its capacity at repaying a debt obligation. So it's something which is very important in the analysis. And second, you've got a capacity. And capacity inevitably goes down to a number of indicators that you cannot take away. It comes down to income, comes down to savings, it comes down to the financial flows, basically, that eventually allow the issuer to repay its debt obligation. So there are many quantitative elements in that, right? That we, of course, we publish. Our methodologies are public, made available. We want them to make sure that it provides comparability on a global basis across sectors and over time. So it's a tough task, right, to put in place something that is clearly challenging. And very importantly, we want them to be to reflect any kind of development that could occur in the market. So whenever we believe that something should change because some quantitative metrics have been evolving over time, or there is maybe a framework that we need to take into account in terms of financial infrastructure, regulation, other things, we do update these methodologies. How do we do it, right? We use stress scenarios, we use credit stability criteria. That is run through some validation internally, that is done on a global basis. And most importantly, every time we update methodologies, we ask comments from the market. These are open updates. We expect market participants basically to come back to us and say, hey, maybe there's something that you're not evaluating enough. Maybe you're missing a point there. Maybe this is too conservative. And believe me, we do get many comments, a lot of feedback from market participants. At times, they find us too conservative or maybe too aggressive in terms of some position we take, and we change that, right, based on market feedback. So that's very important to understand in terms of concept. I think the other thing I would like to add, in addition to these methodologies, the nature of the credit rating assessment, the way we work goes very deep, right, in terms of trying to understand a market. We don't do it based on a desktop analysis that is carried on somewhere in London or in New York. Absolutely not, right? We pay a lot of attention to data that we get from macroeconomists, of course, official statistics from any country or any entity we rate. We go on the ground, we meet with government officials, we meet with representatives of the opposition, we meet with economists on the ground, we typically meet with the IMF resident in a country. So we have a lot of conversation. We want our analysts to be experts, right, in those countries and be able basically to go beyond the simple quantitative measure to fine-tune and to get to the best conclusion.
Guy, I just want to clarify. Hearing you speak with your first point, it felt like there isn't as much openness when it comes to the financial, parts of governments within Africa, and that's something you are hitting on. Is that correct?
I wouldn't put it that way. There is openness, but at times I think that clearly the expectations are not exactly on go beyond basically what we can do as a rating agency. We don't define the cost of funding.
Yeah.
We don't define the cost of funding. I think it's very important for you to understand that we establish a credit rating. It's an indicator of likelihood of default on a comparative basis. It's for investors to take the call at the end of the day in terms of what do they want to do with that, and at what price basically do they want to their capital remunerated.
Hannah, you look like you want to come in because I wanted to bring in Savige. Do you want to add on this before I bring him in?
Well, I think it's worth also just for I guess, I don't know how initiated everybody is into the entire process, but I think it's worth just putting out a bit of information about the state of credit ratings and also the use of them on the African continent. So there is something called the African Peer Review Mechanism, which provides a report every 6 months on credit rating credit ratings of African countries and how they have changed. So I would encourage everyone to have a look at those reports to understand how they change and their current status. What you'll tend to find is the vast majority of credit ratings for African countries are very, very low. And with our kind of best being Botswana, for example. At the same time, many countries, in order to issue a Eurobond, for instance, you need to have a rating. No private investor is going to give you money if you don't have a rating. So they're inbuilt into the system. And we've just actually published a report which looks at the Eurobond holdings of African countries. And we have, at the moment, 91 Eurobonds are outstanding, been issued by 19 African countries. All of those 19 countries, of course, have a credit rating. But they vary significantly. So Guy is right, because the cost of those bonds do not directly depend on the credit rating only. It also depends on how long the period will be that the country repays that bond. But it comes into it because the people who are going to buy the bond will think about what interest rate they want to be, the interest that they will want to be repaid. And of course, if you've got a low credit rating agency, then then you will need to be paying higher interest. So that's how it comes in effectively. And so it is still important, even if credit rating agencies do not have the power to set the price necessarily, they are a very important player inbuilt into the system. And remember, the UN Secretary General just now was saying that we have a system which is highly unequal and problematic. So there is a challenge for the credit rating agencies to be dealing with.
Yes. Before you, Guy, I want to bring in Savijin. I need to remind the audience and those online, we have other panelists online. I haven't forgotten you. And I want to bring in Savijin, who is the Managing Director at the Credit Ratings Analytics. So, Guy, as you pointed out your first point, I think one of the things that for me was clear is that you don't have a whole picture. And I'm just going to leave it at that. I'm just prompting to see if that's what it is. And that brings me to Savijin. I mean, from my understanding, macro accounting is basically to provide realistic picture of a country's financial health. Just talk to us how that fits into this credit risk conversation, and hearing Guy speak, what is happening? I think you're muted.
Maggie, thanks so much for the question, and thanks for the opportunity to speak to you and to share the panel with the distinguished guests today. So I think, Maggie, in terms of your question, it's a very interesting one. I think Guy has raised some really valid points from a credit rating perspective. But I would just say, in terms of your question related to accrual accounting, I think it's really important because, it's a concept that's not focused on to a large extent from a sovereign rating perspective, and it's a concept that makes a huge impact, especially from an African context. The reason I say that is that most countries in Africa report their financial statistics on a cash basis, probably with the exception of Tanzania, which has transitioned to both accrual reporting and accrual budgeting. And the reason why that's relevant is that when it comes down to things like reporting a government deficit, the rating agencies would make cyclical adjustments for example, for economic performance. But when it comes to accrual accounting, that doesn't really translate to the extent in which it should. So I'll give you a good example is, from an infrastructure spending perspective, many countries in Africa, when you report on an accrual basis, for example, if you were to spend, call it $1 billion on a particular project that will run for a 20-year period, if you spend that $1 billion today, it would be reported as an expense. If you were reporting on accrual accounting, it would be maybe depreciated over a 20-year period. You would instead report $50 million as an accrual expense, and that would go towards your government deficit. But not just in terms of instances like that, but also from an overall financial management perspective. Accrual accounting obviously allows for governments to manage their finances quite well. It gives them a good picture of what their assets are, how to optimize those assets. Because when it comes to sovereign ratings, I think that our focus sometimes needs to be a bit more sophisticated. We need to focus on the core drivers of why credit ratings are not doing bad, rather than maybe the administrative process around the credit rating process. So I think with accrual accounting, it allows issues to get down to the crux of what might be wrong. Economic growth, for example, might not be as good as it should be. It would translate into negative outcomes. But in most cases, if you're running your country like a business, as you would having been reported in accrual accounting, these things tend to be a bit easier. So I would say from a reporting perspective, maybe that, and also even from just from a data perspective, just try to put into context some of the other comments in terms of expectations. I think that countries in Africa need to have probably similar to how you get your medium-term debt frameworks or strategies. You need to have a medium-term credit rating strategy or framework in place. I think it's imperative that all countries have it. There should be robust turnaround strategies. With the trajectory of credit ratings in Africa, countries should have these turnaround strategies in place. You could also complement that with the multilaterals such as the World Bank and the UN, where you could have medium-term sovereign credit rating framework tools, that would guide countries and show them that, if you continue on the existing path that you're on, in 3 years' time, this is what your credit rating is going to be. I think the expectation from governments in terms of, when downward grades do occur, based on the methodologies that rating agencies work with at times, they obviously apply the framework, and, if it's negative towards a particular country, if you were to have sort of like a tool that will tell them that, if you continue that path, this is the outcome that you will get, it creates a more realistic expectation on their part, and it also could serve as a tool to provide a lot of impetus for governments to make the regulatory changes that need to be made, to probably attract different rating outcomes. So I hope that answers your question, Maggie.
Yeah, so from your perspective, there are things governments need to do, there are things agencies need to do. I mean, you asked a very vital question, why are ratings bad? And I think we are here to find collective solutions. But I want to bring in Raymond from a development perspective, because at the end of the day, we're looking at critical financing for countries to finance their development initiatives, talking about infrastructure, health, climate, etc. Raymond talked to us about some of the immediate steps that could be taken to, I don't know if it's bridge the gap for governments, for agencies to be able to find a common ground in terms of having better ratings for African countries. I think you're on mute.
I do apologize. Thank you so much. It's such a pleasure to join this conversation. And I think the panelists have already laid out a lot of the important points. I think I'd like to go back to a point that he made about the validation process. I think what this speaks to is the importance of having the right data, having timely data, and having globally comparable data. This is a challenge across the African continent, and one of the reasons why, after publishing the report last year, we have focused our initiative on helping African countries not just understand the data requirements and the process, but also understand how best to bolster their statistical capacity, and so that whether it's a ratings agency or the government themselves or investors take a look at a country and try to figure out its risk, because credit rating is all about how do we price risk across the African continent. When they look at it, there'll be a more appropriate measure for countries, and not something that is based on a large degree of subjectivity. And this is why increasingly over the last 2 decades we are seeing more and more African countries requiring a lot more commercial lending versus concessional lending, which was what most African countries were able to source, say about 2-3 decades back. Looking to the future, the reality is that official development assistance is going to continue to decline towards the African continent, and therefore this notion of how do we make African countries better prepared to play in this particular arena becomes a development imperative. Because without this, we're going to have countries continue to seek financing options that contribute to the debt stress that has immediate development implications. And so 3 things. First of all, understanding the process, understanding how to engage with organizations like Standard & Poor's, Moody's, and Fitch at the validation process, and also when the first assessments are shared, to be able to have the right data sets, timely data, comparable data that paints the most accurate picture. The second thing is countries need to be able to upskill in this area because it's a new area for most countries, issuing Eurobonds, etc. Many ministries of finance, many central banks are not as skilled as possible, so we see lots of countries farming this out to other organizations. And I think looking to the future, it would be better if African countries are more able, more capable to do this themselves. And the third area that I would like to highlight is that we have to make the link between this issue and development outcomes more directly. As a number of panelists have already pointed out, not just from a financing perspective, how much financing and how much it costs, but also the fact that if we do not have, if African countries do not have access to these resources, then the critical investments required for the next stages in the Sustainable Development Goals will not be realized. And so making the development connection, I think, is something that we need to work on a lot as well. Over to you, Maggie.
Thank you, Raymond. Speaking out is access to data. I think you mentioned this a little bit, and how you are incorporating in technology, for example, in your methodologies. You mentioned about the analysts that get to the countries to be able to do the ratings. Could you talk to us more about that? After this, I'll be coming to the floor to talk about a question or two.
Sure. First of all, I want to say that I completely agree with Raymond in terms of maybe what could make a difference in terms of the analysis that we conduct, that we carry on the on governments. Yes, so analysts are experts, right, in sovereign ratings. On the one hand, of course, they've got the global picture in mind, the macroeconomic developments, what are the assumptions in terms of growth, inflation, interest rates globally. But very importantly, they want to understand the country, where it's going, what are the policy initiatives that could make a difference, frankly. And we are very happy to take a forward-looking view on some decisions that policymakers take when we believe that, when we've seen examples elsewhere, and when we believe that it's going to make a difference, right? And we can adjust our scores internally based on the direction, not where a measure maybe stands today, but based on the direction of travel in terms of reform, in terms of growth, in terms of inflation, in terms of independence of a central bank, in terms of many things, right? So it is very important for us to get to the bottom of it to make very informed decision. We come up with a recommendation. The lead analyst at S&P comes up with a recommendation, but is debated within a rating committee. That rating committee is very diverse. Again, we are not talking about people based in New York or in London or in Paris. We are talking about people covering emerging markets all over the world, or a mix of developed and emerging markets, with situations clear in mind from LATAM, Southeast Asia, Eastern Europe, et cetera, etc. And there is a very healthy discussion around it. Of course, we are a key component in the financial chain when it comes to debt issuance, right? And the way we look at things has an impact on the cost of funding. And of course, I would not be debating that, because otherwise I think our job would be a bit irrelevant and I would go and retire. But what I want to say by that is that investors, they've got a life on their own. They may look at things very differently, right? Take the example about 3 or 4 years ago, pre-COVID, right? The same sovereign with a BB minus or a single B type of rating would get financing at 4-6%, easily. Today, we are talking about something in excess of 10%. Because of course, we've got a situation out there which makes it very difficult. Interest rates have skyrocketed in the US. We've got the energy crisis. We've got some geopolitical tension. The risk appetite of investors has come down quite substantially, I think it's fair to say. And this is why, at the end of the day, when the investment decision comes, it's an arbitrage, right? Do I invest in US Treasuries at 5%, or maybe in a BB rated sovereign at 6.5%? The answer is very clear for them, right? What I would like to add as well is that part of our job is to explain our views to investors, global investors. We spend a lot of time talking to investors. And very often, investors, they challenge our views because they would have a more conservative view. And the reason why they've got a more conservative view very often is that they don't get the same kind of access that we've got, right, on the ground with governments. We don't have the same level of information in terms of reforms, right, the policy at the central bank, et cetera, et cetera. And very often they say, well, we've got a more conservative view and we've got to debate on that. We like to insist on this. So over time, during periods of volatility, yes, we're going to find rating agencies being too conservative, too aggressive. It depends on the macro context. I've been at S&P a sufficient number of years at this point to be at the firm when we had the sovereign crisis back in Europe, right? And I can tell you that was pretty much the same type of discussion we had at the time. So today, yes, clearly, given the macro context and the financial needs that the continent is exposed to, right, which is you've got the double whammy of high interest rates, investment in resilience and adaptation to climate change, which is really very significant. The exposure in terms of GDP for low to middle income countries, which is substantially higher compared with high income countries, substantially higher. We have calculated it's about 12% of GDP, so which would be about 4 times. So that need for adaptation and spending is very substantial. We want to be partnering in terms of looking at solutions, right? The type of financing where data would be sufficient for us to provide best the ratings most, that would reflect kind of debt securities that would be based on information we have and that is reliable, et cetera, et cetera. But today, clearly, the situation is difficult.
Hearing you speak, and I'm going to come to the questions, and I know you wanted to jump. Okay, you've talked about flexibility, and I think it's a very good thing to hear, because I think one of the key takeaways we've had in our past discussions has been, we're using this, rating agencies are not adapting to governments and, all the development that is happening. At this point, I'm going to go to the floor and see if there are any questions before we move on. Okay, we'll move on with the panel.
Can we have a microphone at the front?
Good afternoon, ladies and gentlemen. My name is Dr. Dennis Matanda. I'm a professor of contemporary American politics and international business. And some of the things I'm going to say are not necessarily questions, and I'm hoping I don't make many enemies from what I say. So please forgive me for what I'm just about to say. A few days ago, Burkina Faso, the administration in Burkina Faso decided to hold their elections and postpone the elections 5 years from now. A few weeks ago, Uganda's credit rating was taken from where it was to something lower, and they said it was going to be stable. Moody's, I think, it wasn't Fitch or Moody's or somebody. I bring this up to say that the people in this room here are quite nice about the whole process, but the fundamentals in our African countries are very difficult to deal with. We have to say that it's very difficult to go to the rating agencies and say, you know, can we demand, can we find a way of being flexible? Because we, like Guy just said, we are competing for a very small amount of money that needs to be taken at the best rate possible. So for me, I think some of us in this room need to spend a significant amount of time holding our governments accountable. And when I say our governments, I'm not speaking as an African. I'm speaking as somebody who served in the United States Congress as a staffer, and I saw people's opinions of the continent, people's opinions of whatever we have to go through. There's a general discussion like, oh no, it's the African countries again. And you get this poker face that almost says, oh yeah, how do we solve this particular problem? But I want to say that 23 years ago, African countries came together to develop something called the Africa Trade Insurance Agency. It is rated A by S&P Global. It is rated, I think, A or AAA by AA by Moody's or Fitch. And a few years ago, this agency was able to find Benin money for a 12-year period of time with very good exchange rates. I mean, very good payment rates or very good rates. So for those of you who were at Hannah's event earlier today, they released this really, really good report that's also very heartbreaking. If you look at page 4, Hannah, I read the report, and it is just great, but it's also painful because it shows that we are spending a significant amount of money waiting every single day. Is it not possible for us, if we're doing developing credit rating solutions, to go and leverage instruments that have already been used? But most of all, take into consideration that the development story is not just about debt. Debt is not bad. It's just development financing, but related to that, foreign direct investment. Could we not have that conversation as well? I really hope I didn't make enemies. Thank you.
Do we have any other comments? I think we have two at the back. To my panelists, if you want to come in to answer to any other questions, please let me know. I'll take two and then we can jump back into it. Thank you.
Okay, thank you very much. This is a very good discussion. I'm Abi Kadir, Director of Research of African Economic Research Consortium. Nice to see you, Hannah. My question is directed to the Managing Director of S&P. This is in relation to the CPIA, the Country Policy and Institutional Assessment of African Development Bank. We are meeting on the sidelines of the ADB, therefore it is good to mention that. My question is methodological. when you are considering or putting these variables into the formula to come up with the ratings, to what extent do you include the CPIA? Because this is a diagnostic tool for policies as well as assessing the quality of institutional frameworks within the 54 countries. So it is very, very important. I'm not saying that CPIA is perfect, because I criticized it and we published something with the Vice President of the World Bank 10 years ago, but for what it is, do you use it into the formula that you are using for the ratings?
So a credit rating on a sovereign is based on a number of components, one being an institutional assessment, right, which takes into account a number of sub-factors. Any data input that we've got in that space, of course, is taken into account, and we look at historical data, track record, and the direction there. I would say that the governance, the quality of institutions is probably the #1 factor why any country goes into trouble. Over the long term, of course, when a crisis unfolds, there are typically other aspects to take into account, like liquidity crunch, confidence crisis, these type of things. But the institutional assessment is a bedrock of any credit rating we've got on a sovereign, because pretty much everything is derived from it. The second block, if you want, which is very important, is the economic assessment, right? It's essentially the capacity to generate financial flows at the government level, so tax revenues, of course, because this is how you're going to be paying your debt, but also at the population level in terms of GDP per capita. But these two components clearly put together, that gives you a very strong starting point for where do we come up with the credit rating.
And I want to bring you in, Dennis. I'll come to the question after this. Obviously, we're still taking methodology, which is quite interesting. So there's so much curiosity for people to really want to understand how this is done. But also, I think Dennis hinted so much on the link between credit ratings and development financing. I want to bring you on to comment on that.
Yeah, thank you. So Dennis raised a lot of issues, and I also just want to mention in terms of the institutional framework and methodologies, again, we just have to remember that many of these systems were created a long time ago, and yes, there have been updates, but they're not particularly significant updates to methodologies. As an example, even though IMF and World Bank's debt sustainability assessment doesn't take into account, Dennis, you said debt is not bad. There is no accounting in the debt sustainability framework for whether how you're spending that debt. Is it going to be creating an asset, or is it going to be just recurrent spending? That then feeds into a debt sustainability assessment, including these institutions, other elements of it, which the credit rating agencies use. And so then it becomes this sort of, I call it a non-virtuous circle of problematic information that however accountable a government is, however open a government is, we have to be working at these things at several levels. We can't just be doing all of them only. Yes, getting governments more accountable is a necessary part of the equation, but it is not sufficient. We also have to update what the ratings agencies are doing, what the international financial institutions are doing. We need to have more reports like yours, which create the space for change and create the space for structure. And I would also say what we haven't mentioned today is the work for an African credit rating agency, which is also trying to demonstrate that there is a different way out there. And I think that can be complementary to all of the other efforts which are happening. Again, all of those necessary but not sufficient on their own.
I'll just take one, I'll just bring in one panelist virtually, and then we can go back to the question. I want to bring in Savijen. From where you sit, Because Hannah mentioned about the African Credit Rating Agency, but I want to bring you in as the managing editor, rather director, for the Credit Ratings Analytics. Where you sit, as Hannah mentions that we all need to plug in its collective efforts between governments, agencies, development institutions. How do you plug in, and what work are you doing in regards to the agencies and governments? Just talk to us about that. I think you're on mute.
Sorry, Maggie, sorry about that. Yeah, so thanks so much for the question. Maggie, so in terms of the approach to these ratings, and in terms of the African Credit Rating Agency as well, I think it's a phenomenal effort by the African Union. We were actually fortunate enough to work very closely with the APRM in terms of the feasibility studies, in terms of getting this rating system set up. I think it's really important. Probably in Africa, if you look at just in terms of just basic sovereign credit rating coverage, it's about 36% of African states that have no credit ratings, sovereign ratings from S&P, Moody's, or Fitch. Obviously, a lot of those countries are not in a position to borrow from international markets, but in terms of credit ratings and the importance in terms of developing financial systems, developing financial markets, being a key pillar of the actual financial architecture of any particular country, I think the African Union's rating agency, once it is set up, will make a huge impact from that perspective. It will provide an alternate opinion. So I think it's much needed. In terms of some of the work that we did with lots of international investors, with lots of large international investor groups, a lot of them were for the African Union's rating agency, just to provide them, with a different opinion on the credibility of African countries. So I would say, Maggie, in terms of the African Rating Agency, I think it's a phenomenal effort. In terms of some of the work that we're busy with on the ground, I'll probably, run you through some innovative projects that we're currently working on. Sorry, just before I continue, Raymond, I think you've got your hand up. Raymond, you wanna add in something? Okay. No, it's fine. So in terms of some of the innovative projects, Maggie, as I've mentioned, when it comes to credit ratings, and if you want to move the needle from a sovereign rating perspective, you need to get down to the crux of, what are the drivers behind your credit ratings being negative or on a negative trajectory. So I think a lot of countries in Africa in particular, struggle with external liquidity issues. A lot of them struggle with dollar shortages. It becomes a bit of a challenge. You borrow in foreign currency, but you're not earning much in foreign currency. Your industries are not very competitive. So, for example, in Nigeria, we're working on a very innovative project. The country obviously struggles from an external liquidity perspective. We're actually assisting them. We looked at different ways of how we can actually improve the competitiveness of firms, which can obviously indirectly improve external competitiveness and translate into credit rating changes. But we're actually setting up a public sector SME grading system in Nigeria. It's the first public sector grading system in emerging markets. It will be one of the largest ones fully set up. But it's there to obviously assist countries. To assist the country to promote exports. Obviously, with exports, you're showing up your dollar reserves, and you're boosting your liquidity. So I think we need to get down to the core issues. In other instances, it's assisting countries with some of your internal engagement frameworks, your external engagement frameworks. I think it also talks to Raymond's important point, about legacy governmental knowledge. A lot of countries in Africa, don't have that legacy governmental knowledge. So I'll give you a good example. In South Africa, we've had credit ratings here for a long time. There's very sophisticated internal risk signaling tools that the Ministry of Finance has in place. But that's been passed on through different administrations, probably from the early 90s up until now. So although the country's credit ratings are the best, the back-end systems to run the actual credit rating process, engage with rating agencies is obviously top-notch. So a lot of African countries struggle with that. You need to have a very comprehensive engagement framework with rating agencies. that will encompass various things, in terms of your data collection, your proactive risk signaling. You need to identify areas of weakness. So it's much more of a proactive approach when you're engaging with rating agencies. It's not just a question of them telling you what's wrong with the country. It's you've identified these areas of weakness, and you obviously presenting maybe a plan around how you're going to address it, rather than just hearing about these things. So even in terms of your internal engagement frameworks, which will speak to other ministries that are linked to solvent rating. So as Gay pointed out, the solvent rating is made up of various aspects or various metrics that a country is measured on. And that obviously translates into different ministries that are linked to the country's overall credit profile. So you need to have a robust engagement framework with all of those. Your ministry is linked to your state-owned enterprises, which typically carry a lot of contingent risk for governments in Africa. You need to have those engagement frameworks in place so that the credit rating concept is taken seriously. But I think from an Africa perspective and an Africa approach, I'm actually really excited by the involvement of the UNDP within the operating space, because it needs to be a collective effort from various stakeholders. When you look at a concept like public sector debt management, you're getting assistance from the IMF, the World Bank, various institutions within the UN. So I think that we need to follow a collective approach where countries get assistance from various stakeholders. The work that the APRM is doing is absolutely phenomenal, but I think there needs to be additional support for countries to build up these systems, build up these internal risk tools, and hopefully when we have this discussion again 5 years down the line, countries are in a much better position to engage with rating agencies, and hopefully it translates into much better rating outcomes.
So we've actually had a conversation with African finance ministers in the past. Obviously, we know what the problem is. We have low ratings, but we're looking for the solution, and this solution is between different parties, and that's the agencies, that's the development institutions, and the governments. And I want to bring in Raymond before I go back to the questions, because I have so many here. Dennis talked about accountability, if I must frame it like that, saying we need to hold governments accountable. Obviously, I know with a lot of work UNDP is doing in terms of engaging governments, especially when it comes to development financing. What would you respond to Dennis? I'm not putting you in the shoes of the minister, but from where you sit and engaging with them.
Thank you so much, Maggie. And thanks, Dennis, for that excellent question, as always. No, you haven't made any enemies. I think you've shed light on an important issue. At the end of the day, we are focusing on how does this affect development financing and also foreign direct investment. And our point in this context is that a country's credit ratings provides a benchmark of how the market views risk in that country. And so even though the credit ratings itself does not directly frame the interest rates, etc., but it is viewed by the market as the indicator, or the lead indicator for risk. And not only the markets, even within African countries, investments by central banks, investments by pension funds, insurance companies, all look at the credit ratings. And this is why we think it is really important. And Hannah's point about how do we make these things more reflective of reality? And her point about, okay, maybe we need to look at the debt sustainability analysis and look at, what is the borrowing for? I know that the credit ratings agencies are thinking about this in tweaking their methodology. I had conversations with senior people at the World Bank. They're also thinking about this. And what we are saying is that this needs to be done much quicker. It needs to be a whole of community approach where we have the ratings agencies, the countries, development partners, insurance companies, all working together to lift African countries to that stage where they have credit ratings that reflect their reality and that are also development friendly.
Thank you, Raymond. We have a lot of questions. We actually have another audience just outside that just sent in the questions for Guy. And one of the participants says, not all institutional investors need AAA. Why do you think they do? And can you design products for this rating? Is there a way around it?
Sorry, not all institutional investors?
Not all investors, institutional investors.
Need to?
Need the AAA ratings.
Sure, I would agree with that. 100%.
So the question is, why do you assume they do?
I'm not assuming anything. I'm not too sure to understand the question. Investors have appetite to invest across basically the entire rating scale. At the end of the day, they do an arbitrage between, of course, AAAs, and we've got still many AAAs in the structured finance space, right, specifically. Not too many for sovereigns, actually. We've got only a handful left. Down to the BB, single B, and triple C categories. And actually, beyond the sovereign space, I think 75% of our rating population in the corporate space is at either BB or single B. 75%, right? So, and that makes investors absolutely happy. But at the end of the day, they've got to do an arbitrage, of course, right? And it depends on macroeconomic cycles, depends on financing cycles. What is relevant, I would like to rebound on what Raymond said before. The quality of the data, right? The reliance of the data, the predictability that is provided to them is absolutely essential. Risk appetite from the investors, they're happy to take on quite a bit of risk in return, of course, for comparatively higher yield. But that is only based on the fact that they trust the data that is provided to them, the predictability of policy making. You know, governments basically focused on fiscal discipline and external keep external imbalances at bay. This is what matters at the end of the day. Having a comparatively low credit rating is not a complete impediment, basically, to get the financing that any entity needs, including sovereigns, of course. That comes at a cost, and it depends on where the money is spent, right? What is essential, again, I said that before, in our analysis, is that we look at the direction. We really look at the direction. We are happy to take a forward-looking view. So you could have a country positioned at a certain level in terms of GDP per capita, for example, right? Just to take one indicator. We are happy, absolutely fine, to assign it a higher score if we believe that the growth dynamics is there, if we believe that the right investments in terms of infrastructure or the way FDIs are flowing into the country are there. This is actually the case in this country, right? Where we score higher and not stick to what the KPI itself would tell us, right? So we want that flexibility. Because believe me, I've been in that job a big number of years now. The worst feeling we can have is when we think that when we could look that we are some kind of lagging indicator. We don't want that, absolutely not. And therefore we want to look forward. But at the end of the day, clearly some data, the quality of data, the level of the data is critical.
We had a question at the back. Can we just have it?
To the distinguished panelists, ladies and gentlemen, my name's Mboya Stephen from Kisii University School of Business, and I'm an upcoming data scientist. On the issue of accountability, the panelists said you need more information. I also had an issue on accountability. In Africa, let's say about requesting and getting grants. For example, let's talk of currently, for the people who will receive grant or the loans, are, let's talk of between age 50 to 60. None of them during the payment period or compensation period will be in contract of working. Therefore, getting the accountability and the clarity of how this money was used and how it was spent is becoming a problem, because you find that the person working currently doesn't have an idea about the terms, and he can explain nothing of how this money or the grant was used. Yet he has to explain and give explanation and also take part in paying the interest. So how can we come up with a solution of where the person receiving or getting the grants or loans is able to be there, be accountable, and give clarities, even when he's asked, how was it used? He can give clear details, because when someone is out of office or not working, you cannot follow him or her up to give information about what is going on in the office currently. Thank you.
Yeah. There's another question. We'll take 2 questions.
Thank you very much. My name is William Asiko from the Rockefeller Foundation. Thank you very much for this very wise advice. My question is about the African Credit Rating Agency. A few years ago at the foundation, we started doing a body of work called the Global Economic Recovery, which involved things which have today come to be known as Bridgetown Initiative and other things. And part of that work for the Africa bit involved my traveling to many African countries to understand what their interests were in this multilateral development bank reform, global financial architecture reform. And we were a team of different experts, and in many countries we went to, we could not even get a debt register from the country. These countries had never done a debt sustainability analysis of their own debt. Many of them only knew they were in debt distress when the IMF showed up and showed them their own debt sustainability analysis. So I think that I do agree that an African credit rating agency is necessary and would be helpful in the sense that it would provide an alternative view and so on. But would it not be more useful for this credit rating agency to help African countries understand the link between their low ratings and the things that they can control, like the strength of their institutions, the strength of their capital markets, and the link between public financial management and those ratings? Would it not be more helpful, because we know that the African Credit Rating Agency isn't really going to move the needle in changing the ratings for sovereigns in Africa. I would really like to hear, would it not be more useful for this agency to focus on this sort of capacity building within African countries and their ministries of finance? Thank you.
Hannah, you might need to give us some bit of optimism.
You can always rely on me for optimism and energy. Okay.
To what extent, he's asking, can really this make a difference?
I want to go back to what I said earlier, which is that all of this, many of these activities, all of them are necessary, but if you just do one, it is not sufficient. So if you work every day, which many organizations have been, including, we have a capacity building foundation, for example. We've got many organizations that work with debt management offices to really improve the quality of what they do, and we have some fantastic debt management offices out there. Again, here's me. We do. I am the Africa champion. We do have them. But at the same time, of course, we do have struggles. So we have to work on continuing to improve, and I think there needs to be continuous finance and support for that, and including, I also want to bring in this idea of working together and learning from each other, because that's what some of the organizations often work in silos and working with one government and another government, and another government, and another government. Actually, something that where, UNDP and Africa Catalyst in your initiative, something that you can really add value is actually by bringing countries together to learn from each other. And again, that's something that some of our best institutions, like the APRM, do. That's inside their sort of the way that they operate. It's about learning from each other, reviewing each other. So I think, yes, an African credit rating agency will not solve all the issues, definitely not. But I think it can, one of the things that it can do, for example, is challenge some of the methodologies and the transparency around the methodologies. Guy has talked about flexibility. Some people might call that lack of objectivity. So you can use different words in different settings, and there is no doubt that many of our governments do feel that there are problems when there are with credit ratings. So, even just a cursory examination of some of the statements from African governments, literally over the last 10 years, we've had 20 different statements saying we don't like what this credit rating agency has said. Not always S&P, sometimes Moody's, sometimes Fitch, etc. And that's just a cursory Google search. And they will cite that they have provided information and that information hasn't been taken on board. And at the same time, you'll have the credit rating agencies that say, we didn't get the information. So there's a truth somewhere in the middle. But that's why I say exactly the same point. It takes two to tango. You have to have work on different levels, and and all of those can be mutually complementary.
We had a question, sorry. I'll take 2 questions and then we will have some, these are many questions. We have 30 minutes, 20 minutes left, 15. Okay, I'll take 2 questions from the back.
Good afternoon, everyone. My name is Ikechukwu Ihagwam. I work for Agusto & Co., which is a Pan-African credit rating agency. Pleasure to see you, Hannah. So good, fantastic. My question to be directed to you, Hannah, and also Savashen, and it's from an optimistic standpoint, technically. So don't be just giving you some heads up. We've talked about developing credit rating solutions for African financial needs. That's the theme for this particular session. We need to start thinking inwardly. And some data here, just to share insights. UNECA says we have about $527 billion that can be generated annually from Africa. And the AFDB postulates that about 68 to 108 billion is the financing required for infrastructure in Africa. And piggybacking on what we've said today regarding the fact that some of these rating outcomes may not change in the interim in terms of the outlook for ratings, and also the work that APRM is doing in setting up ACRA, which we are part of. Part of our thinking would be, could we begin to think about an African instrument sold to Africans, for Africans, given that we have the resources in terms of the financing capacity and also the needs in terms of the output. So our thinking here would be, can we develop solutions that are local for Africa? And also, can we begin to think about an African rating methodology rather than having the international and the local as we currently have today? Because we have the international and the local, can we have an African-wide rating methodology that helps us appraise African countries within Africa on an African scale? So I thought it's important for us to hear views from Hannah and also from Salvation, given the work they're doing around credit rating analytics. Thank you.
I think we can bring in Salvation. Let's take the answer and then we can come back for the question. Can we have the vice panelist?
Thanks so much. Thanks so much, Ike, for the question. It's good to hear from you again. Yeah, I think Ike, that's a really good question and a suggestion simultaneously. In terms of to answer your question, in terms of the African rating agency, as you know, we've engaged extensively, and you've obviously provided your insights into. I think that there definitely needs to be a methodology for Africa. The reason I say that is, we just need to look internationally to get some idea of how that's worked internationally in terms of translation into a success. If you look at scope ratings that operate in Europe, they designed a methodology that's applicable to Europe and applicable to European corporates. So European corporates are traditionally maybe a bit more conservative in terms of their cash management, in comparison to US companies, which are more, from a quarterly profit perspective. And US and European corporates, the methodology speaks to that, which is sort of underpinned the success that they've managed to achieve over a short space of time. So I think from an African perspective, you definitely need an African rating methodology. Obviously, with Augusto & Co, you guys are one of the first African-owned rating agency. But there's obviously about 20 rating agencies in Africa. But obviously, your question relates to sovereign ratings and sovereign methodologies. Again, I fully concur. I think that just in terms of the variables that would be used within that scorecard. So obviously, in my personal opinion and based on the analysis that we've done, certain variables such as GDP per capita adjusted for purchasing power parity, with some rating agencies, it's not, probably two of the big three, it's not. When you are measuring probably, the economic impact of external events. So, if you have an African methodology that speaks to that, the investor base in Africa might take a longer term view, so it might not be a medium term. Chinese investors that are heavily invested in Africa might take a longer term view. So, if you have a methodology that speaks to maybe a more longer term approach, that could definitely help. And just to add some context, with the African Rating Agency, I think the AU has come to the agreement that it would be a private sector rating agency that they would partner up with. So I think that would add some credibility to the exercise. It would be endorsed by by the AU. So I think there definitely needs to be solutions for Africa. And if I could just add one more thing, I also think that there should be a bit more African bond indices as solutions that's included. And the entry criteria for those bond indices should obviously include opinions from African rating agencies, because when we try and improve competition on the African continent from a rating perspective, and provide a bit of a platform for local rating agencies, I think importance, credibility stems more from importance than actual credibility itself. The big three rating agencies, a lot of the credibility is derived from their importance in terms of various bond indices and the entry criteria from there. I think if African rating agencies, ones that are doing phenomenal work, such as in Augusto & Co, if we could have some indices with major bond indices from major stock exchanges on the continent or major financial institutions, it would obviously improve the appetite or the need for ratings from African rating agencies. So I thought I'll just add that in to answer the question, but I'll hand it over to Hannah, who I'm sure will add a bit more as well.
Hannah, when he talks about having African methodologies, how does that look like in terms of enabling countries access critical financing?
Yeah, so I think, again, one of the components of an African credit rating agency, the work that APRM are doing, is looking at the methodology question and what could be different, what could be differently done. Another issue that they're looking at is, for example, the localization of analysts, for instance, so making sure that you have analysts who are on the ground, who are constantly tracking changes, which again means that, again, communication between that communication, again, that Guy was talking about, of whether credit rating agencies have to come in to then speak to governments. They might have, the African credit rating agencies should have, regular contact, much regular contact with governments and other key players in the market. Methodologically, I think one of the questions, just as an example, is things like how you treat informal markets in some of these questions around institutional frameworks. A country like Kenya, many African countries, we have very large informal markets, and although many of them are not, they're obviously not taxed, but they are very active. So while the government can't always rely on the informal sector to get money for repayment, the resilience of the informal sector is something that you can take into account in terms of the willingness aspect to repay, because you may not you may be more conservative in spending where there are shocks in terms of spending on citizens, because they are effectively having to also look after themselves. All right, that's just how an informal economy works. That doesn't mean that an informal economy can't change. It doesn't mean that there is not development happening, but it is an important aspect to take into account. So, and again, you know, the issues around asset creation, we talked about that earlier, taking those issues into account. So I think an African credit rating agency can use the information that other African credit rating other African credit rating agencies, especially domestic credit rating agencies, and also a more specific way of thinking about African economies, which is tailored to our situation and our development level. Sorry.
Okay, is this a conversation that has crossed some of your discussions with African governments in terms of ratings?
In terms of what, sorry?
Ratings, in terms of, you know, African methodology.
You know, I'm not exactly sure what to answer that question, because as I said before, our methodologies try to be consistent globally, look at a number of factors at a global level that could be interpreted in the same way and give you the same outcome. And this is what investors are looking to get, right? Because they've got to make these investment decisions all the time. There are some specificities, of course. Every time you go to a certain continent, a certain country, you've got the informal economies, you've got institutional frameworks which could vary a lot, and we've got to understand effectively how does it work. We try to be agile, to clearly understand what is the implication in terms of willingness and capacity to, to face financial obligation over the long term, right? And we adjust continuously our criteria if we believe that something is meaningful enough to be taken into account. Now, if we are talking about methodology changes, which with the sole objective basically is to get to a rating outcome which would be higher, I'm not too sure what impact it would make. Because at the end of the day, you would have to do it, say, for the entire African continent. I would imagine that if the new methodology has legs, right, but the relativities would stay, right, in place, so that notion of arbitrage would stay in place, and then investors would have to make decision about that. And the point is not about expanding or raising the average rating level on a country, right? It is about providing data that can be seen as reliable, where you've got visibility in terms of the financial policies, the stability of the government. When you don't, you take an amount of foreign currency volatility which is acceptable. Convertibility risk is acceptable as well. These type of things, right? So methodology can give you a different outcome. We would absolutely value the fact that we get information on we would get information on data points on aspects that maybe we may have missed.
Yeah.
But I'm not too sure what difference it would make.
There is limited flexibility. Let's for a moment hold it at that. I want to take 2 questions, and then I'll come back to you. I'll take the gentleman with the mic.
Thank you. Oh, sorry. I will go first. Sorry for that. Yeah, my name is Shem Joshua. I work with the AfroDAD, that's Africa Forum and Network and Debt and Development. I think my friend posed the question that I had, but I'll just emphasize on one thing. To start with the UNDP research they did in April 2023, they confirmed that if it were not for subjective assessment, Africa would have saved approximately 75 billion under the credit rating, which was done, and that can tell you very well that with the coming up of ACRA, or Africa Credit Rating Agency, we have opportunity to redeem ourselves. And I believe that looking at the bigger picture, and I can confirm that the need for having, I call it indigenous credit rating agency for Africa, because anytime there's an increase in, a negative rating for Africa, you'll realize that there's an increase in interest rate payment for our debts. And that can tell you something we call systematic increase in paying the debts. And I believe that there's need for clarity for Africa countries to have in a way that will allow them to manage their economies independently. However, I think that with the work that we do, the Afrodad work we do in terms of capacity building members of parliament, capacity building government officials with other CSOs, I think it's very important to make it important that data is very important when it comes to methodological approach. So I think it's very important that we take that into consideration. Thank you.
I'll take the last question. And we have very limited time, but we will make sure that we give all your questions to the panelists. Thank you.
Sure, I don't know if this is on. So on the question of a sort of African credit rating agency, without being a pessimist, I tend to agree with your notion that I'm not sure it would really make much of a huge difference, because the events would tend to be aligned with the top three, and perhaps you would have a sort of nominal difference. And what would effectively change is the risk premium. And so perhaps you might have 100 bips or 200 bips risk premium difference, but the events would kind of be moving in the same direction. My question to the floor is, how much of this sort of methodology of credit rating agencies is missing things because of the perceptual approach towards political risk and political risk analysis? There was a period when the United Kingdom had, I think it was 5 or 6 prime ministers in the space of 3 years. In some instances, if that was an African country, would have been considered a failed state, etc. Obviously, the United Kingdom has stronger institutions, and so on the basis of that might be able to maintain a very good rating. But for all intents and purposes, the perceptual approach to the analysis of that risk is vastly different according to the geographies that it happens in. So how much of that is actually what's driving the difference or the missing gap in methodologies? My second question is, in the current methodologies, how much of the regional approach or the regional integration institutions are accounted for in terms of political risk? Because what you find is, because we've got, say for example, the Central African or West African CFA franc zones, these institutions have got institutional approaches that neutralize a large part of the exchange rate risk. They've also got a foreign exchange rate reserve pooling, which does neutralize a lot of the national exchange rate or convertibility risk that is there, and how much of the methodology accounts for that. And then my last question is, how much of the African sort of risk premium can be accounted to due to spillovers in advanced economies? For example, more recently, we've seen an obvious increase in central bank interest rates in response to inflation, but a large part of that could have been resolved had Russia and Ukraine reached a peace deal 3 months into the war, and they wouldn't have led to an energy crisis, cost of living crisis, or interest rate hikes, which have a spillover. And so I'm quite interested in how much of the policy mismatch or incoherent policies of advanced economies leads to a spillover in African economies. Thanks.
Yeah, no, thank you for the question. 3 very good points, actually. So, number one, on policy, political risk, exactly. Yeah, that's clearly a question that we need to ask ourselves continuously. I think I want to say, first of all, that we take a completely neutral approach to change in governance or the political system. That is not for us to judge, take a position on that. We just look at governance, of course, in terms of the way it's balanced and ensure that the rule of law is respected in countries. We also look at predictability and the soundness, of course, of public policies, right? Stability over the years. So every time that there is a change in the government, we ask ourselves the question: okay, what can it, what could be the impact long term on the public finances of the country, right? So there is political risk in any country, of course. Africa, in the past, in the recent times, of course, have been subject to a number of political events in the Sahel in particular, right? So this clearly may have an impact on the way, and did have an impact on the way we look at these countries. But apart from that, we look at the strength of the institutions essentially, and I want to say that we have no bias there, right? I think we may assess, political risk in some very developed markets in pretty much, relatively close way, and how do we look at some African countries, right? We assigned a rating last year to Mauritius, for example, which came up with an institutional score which was relatively quite high, actually, and yet this is a very small economy if you if you look at it. The second point was on. Can you remind me?
Regional
integration institutions, which bridge the gaps with.
Yeah. So that's a very good question, and probably one where we should be continue to spend quite a bit of time. When you look at the monetary union of the Western African states, of course, it has had very positive impact when it comes to inflation, for example, so stability of the economic landscape, and that definitely has played in favor of some of these markets. For example, we moved the outlook on Côte d'Ivoire to a positive level at this point. So clearly that did the monetary union there did play a part in that, because that does provide stability. I think how do we look at that is something that certainly we should continue to look at, because it is only at the time of crisis that you can see effectively the benefit that it brings. And I think over the past 3 years, we have seen quite a bit of that. And the spillover from developed markets via the macroeconomic, the geopolitical tensions, yes, of course, that does have an impact on the global financial systems in terms of interest rates on the one hand, and increasing geopolitical risk, and the impact on shipping costs and a number of things there, energy, of course. I wouldn't say, many markets, many of our ratings have been impacted by that across developed and developing economies. Over the past 3 years, we have definitely moved down a number of ratings we've got on Africa sovereigns, yes, but proportionally, actually, we moved more ratings outside of Africa. In LATAM in particular, but not only in LATAM, in developed markets as well, in Eastern Europe, and some markets in Asia as well. So it did have an impact, but again, I would completely oppose the view that we've got a negative bias on the country. Methodologies are what they are. They could be more agile. There are some soft elements that we need to continue working upon, of course, but there is no bias.
I think thank you, Guy, and I want to wrap it at this, but I'll leave with one question to all my panelists, Savage joining us online, and Raymond, Hannah, and Guy. If we were to have this conversation next year in May on the 28th, let's say somewhere in another room, what kind of points or key points would you like to hear? We've come from what the impact was of credit ratings to Africa's development. A lot of money, enormous figures UNDP shared in the report last year. Today we've looked at, what are the solutions? How can we collectively work together? Let's assume we're having another conversation on the ratings, and I'm going to hold you accountable to this, because I know we're still moving forward with Africa at least and UNDP, so lots of conversations. What areas should we be looking at and addressing? Thanks. I'll start with you.
Thank you. A very good question. I think, so number one, the initiative, I hope, will have begun, and what we'll have seen is African governments being able to say, this is what we learned about the process from each other, and with the support of UNDP Africa, that we realized that we could share this kind of information or whatever, and actually that would be more helpful to the process. And as a result, we had a positive shift in our rating. So I'd really love to see that story. Second, I think by this time next year, the Africa Credit Rating Agency should be launched. And I would love to have Guy back on here to say, actually, I'm really surprised by how interesting that methodology is, and their aspects of localization and transparency, and we will be looking at using that as a model for how we go forward. So I think those two things would be great by next year. And my firm,
this is live streamed and recorded.
We will do whatever we can to help accelerate that process.
Thanks, Anna. Guy, we're just looking at takeaways. Are you going to feel the same way as Anna looks to you to say, I hope this is helping you in your analysis? Are those some of the things you want to discuss next year?
And Anna, I can tell you that I promise I would be the first one to be, the happiest in the room to tell you, yes, we have learned new things, right? Because at the end of the day, we want to absorb as much information as possible, and any addition to the data set we get, or external views, are very welcome. So for me, clearly, I hope that, first of all, we are talking about a stabilization of the economies, right, which clearly have been badly hit by the recession, the rise in interest rates, etc., and that international investors, right, not only African investors, but international investors, turned back to Africa after, being really focused on what's going on in the US, in particularly with interest rates, and look at it as an opportunity, basically. And that expectation that we've got around mobilization of private capital, right, which has been well below expectation, that happens really with structured financing around it that works for Africa, with guarantees, of course, with multilateral lending institutions accompanying this project that we talk about, bankable projects for private investors, of course, but instead that resilience and adaptation investments are, clearly led by MDBs more generally, right? That we've got a framework which is a lot more stable, that gives direction in terms of investment, right? How's the adaptation, sustainable finance is gonna work going forward, and there's a lot to be done. Second, as well, I hope that we have a bit more clarity around the common framework when it comes to debt relief initiatives, and I think we haven't talked about it, but I don't think we should underestimate the significant progresses that have been made in that space over the past year and a half. It's been very slow, right? But if you think that now you've got so many parties sitting at the same table, with the Chinese, the MLIs, generally speaking, and of course sovereign governments sitting at a table and starting talking about it, finding common ground, and then bringing Eurobonds to the table to see basically what can be done there. If this is, for example, in very good progress at the moment on Zambia, I think if we start having this type of situation being unfolded, that provides a lot of visibility and clarity to financial market players, essentially, and you start certainly seeing, potentially the cost of financing coming down. And the last point is what you said, Anna, before, and it's been a recurring theme since the beginning. It's really around understanding of what it takes, right, to have positive assessment from credit rating agencies, of course, but investors much more broadly in terms of fiscal discipline, external positions, essentially, the data that should be provided to the market on a continuing basis, and the reliability of that, et cetera, et cetera. That would be a huge step forward, because this is effectively what everybody is looking for.
Thanks, Guy. Online, I would like to bring in Savashen. If we're having this conversation next year, let's look at the key takeaways. Obviously, we've heard from Anna, we've heard from Guy. What would you want the conversation to be focused on?
Yeah, thanks, Maggie. And it's a really good points that the panelists have put up. So actually looking forward to that discussion next year. But I would say that for two important things, I would say it'll be good to look at a year down the line what policies, procedures, and programs have been put in place by sovereign states in particular, just to manage the entire credit rating process as a start. And to try and work towards better credit rating outcomes, because I think discussions like this here are only important when action is taken by the actual end users, or obviously the African sovereign states that have these ratings. So I would say that would be the first. The second, Maggie, would be to also look at how the initiatives by maybe some of the major multilateral organizations within the credit rating space have planned out. Obviously, the UNDP has probably a very interesting program that they're in the process of launching. So it'll be good to see what's the outcomes. But even some of the other major multilaterals that are working on maybe from a capacity building perspective, just to have a look at what has been the progress thus far, so that if we sit down next year, we can maybe build on some of those programs and look at how they can be improved. Or what can be added to it to make it a bit more effective. So that would be my 2 points, Maggie.
Thanks, Safijan. And we have, I think, about 10 minutes or less left, so I would like to bring in Raymond. I think one of the things that has come out extensively, or that has been key, has been development financing. And I know that together with Africa, at least, there's a lot of work that is being done in terms of empowering, supporting different players to support governments, but also work with the agencies and see how to navigate these credit ratings. We had this conversation last year. We're having it today. If we were having it next year at the same time, what would you like to see?
Thank you so much, Maggie. Great conversation. 3 things. One, I would like to see greater awareness, particularly across the African continent, of the link between how risk is priced on the African continent and development financing. Secondly, I'd like to, of course, naturally hope that the new Africa Credit Ratings Initiative that UNDP is working on with Africa Catalyst would be up and running, and that we would begin to, we will be able to start tracking progress, not just in terms of facilitation of the credit ratings processes, but also concomitant reduction in the cost of borrowing, and also an increase in the volume of FDI coming towards the African continent. Third, I would hope that we have a platform
where we could have Guy and colleagues from global credit ratings agencies, African credit ratings agencies, the APRM, other development partners, working together to improve both the methodology and the transparency of the process, and so that at the end of the day, we are able to have a process in place that does reflect not just the reality, but the potential of Africa's market.
Thank you, Raymond. These are promises you've made to the audience, online and here in this room, and we're going to follow up with this conversation with another discussion, hopefully next year. At this particular point, I would like to ask everyone to join me in welcoming Dauda Sembène, the CEO of Africa Catalyst, to give us the summary of next steps and close the session before I let my panelists go.
Well, thank you very much, Maggie. And let me start, first of all, of course, fulfilling this very non-viable task of bringing a close to such an exciting discussion. I think we were here, we could have stayed for more hours without actually having enough of this discussion. So this is what I'm going to do, and I'm going to be very brief. I think as was discussed during the discussion, I think this is a follow-up to a ministerial discussion that was organized by UNDP and Africa Catalyst in Washington last year. At that occasion, we had actually the perspective of ministers. So today, we were very much privileged to have representatives from credit rating agencies, also from development institution, multilateral private sector, and also, of course, here the perspective of academics and other in the room, research centers and others. So I think this was extremely critical. So what I'm going to try to do, and this is extremely difficult to do, is to find the key takeaways for the discussion and, of course, the next step as far as the UNDP and Africa Catalyst are concerned. So in terms of key takeaways, I think we all agree about the importance of this topic. When we talked about credit ratings, we are talking about actually sort of opinion that do have a bearing on the cost of development finance. And of course, that also have a bearing on the ability of countries to meet their sustainable development objective. And of course, this is extremely critical. As Raymond said, these are very much linked to development outcomes. So we really need to really take it seriously and know and discuss about it in a very way. But the problem is when we talk about credit ratings, many people don't know what they do. And those who know what credit rating agencies do not know how they do it. And those who know how they do it are usually silent, and that's usually actually this credit rating agency. So today was an extreme, very welcome opportunity to hear from people like Guy, and we are very much grateful for your perspective, and of course from Hannah, who has done a lot of work on these issues, and also thank you very much for that. So just in terms of key takeaways, I think this was an opportunity to demystify what credit rating is about. I think that was, to paraphrase Guy at the beginning. And also it was an opportunity to help African countries be better prepared as they seek increased market access amid declining ODA. So I think that's the purpose of our initiative with the UNDP. And I think to achieve this objective, there are a number of insights that were provided by the panelists today. One is the importance of having timely, reliable, and sound data. I think this is the key for having good ratings, and I think this is the onus that this onus is on the part of African government to do so, and that's critical. Another thing they also need to do is to be able to really have predictable policy making. I think this is critical. Sound institutional and governance framework, that's also critical for good ratings, and I think that's the responsibility of African governments to do this. So I think for that, I fully agree with what Hannah said about the importance of peer-to-peer learning. I think the importance also of capacity development in terms of actually how to really learn from each other's successes and failures, because this is part of the life. And I think that is critical for really doing those objectives that we talked about. I think the panelists also talked about the need for developing credit rating analysis and alternatives whether we are talking about local credit rating agencies in Africa or actually the AU sponsor African credit rating agency. That's also critical. I think the good thing is they would provide some sort of alternatives and also hopefully help really improve the methodologies, which is also another key takeaways from this discussion. How we can shed more transparency over the methodologies of credit rating agencies. They're doing it already. They have posted in their website their methodological approach. But as Guy said, this is a work in progress. You need to continue refining further and making sure that you reduce to the minimum possible the subjectivity that might, just like every assessment, be sort of affect any assessment. I can tell you that because I was a former evaluator working at the IMF executive independent evaluation office. So when you do evaluation, you know that you cannot go by without actually having some subjectivity. But you need to really lower it to the extent, to the maximum possible. And I think transparency can help do that, and of course, working, having a robust engagement with stakeholders involved in the process, not just the rating agencies, but also, of course, the government, the African government, the other domestic stakeholders, and development partners. I think that would be very much critical on the way forward. And I think at the end of the day, also, both credit rating agencies and African government needs to be held accountable for doing what they need to do. I think Denise was very much right about making sure that the government also are held accountable for that, and I think this is also important for credit raising to do it, because they are entrusted with a critical sort of responsibility of facilitating the movement of capital across markets and countries. I think they have to do it in the best of their ability without any bias, whether it is conscious or unconscious, and I believe that's what we all aim at. Next step, as far as UNDP and Africa Catalyst is concerned, I think we heard about the Africa Credit Rating Initiative that we have been implementing, these two organizations. We are going to continue to do that, and of course it involves having that dedicated online platform that Raymond talked about. It also involves having a consilium of advisors that would be working with African government to make sure that they really understand the credit rating process and actually take the most out of it and making sure that they improve their ratings. That would be something we will do. And that also would involve a number of workshops that we will be doing at, as Raymond noted, particularly in countries in the region here in East Africa. I think that's critical. And finally, let me just do what I needed to do since the beginning. It's actually a thank you note. And my thank you note would start first, of course, with our distinguished panelists, Guy, Hannah, and of course Sabishan and Raymond. They have done a great job and they all deserve a round of applause if you can. Of course, the second, my thanks also go to UNDP, our partners on this endeavor. I think they're doing a great job, and as you may all know, I think UNDP was the first organization that helped many African countries get credit ratings. This is actually something that has been very much critical for actually, making where we are right now. And I think UNDP also deserves a round of applause. And of course, I would also like to thank the joint organizing team, both from UNDP and Africa Catalyst. And I cannot stop without thanking, of course, Maggie, the moderator, who has done a great job of facilitating this discussion. And last but not least, the audience, both online audience and also those who are in the room in person. Thank you very much for coming. We will certainly keep you posted as we go forward on the work that we are doing as part of this initiative. And of course, we are always happy to continue working with all of you and making sure that we actually push this agenda forward. So enjoy the rest of your day and have a good stay in Nairobi for those who don't live here. And those who live here, of course, karibu sana. Thank you very much, all of you. Asante sana. Thank you.
Million stranded, 15 million Kenyans stranded because of a simple decision that can be made to change, to keep the credit reference bureaus, but change the scoring mechanism so that it's not all or nothing.
divergence between developed and developing countries is becoming systemic, a recipe for instability, crisis, and forced migration. These imbalances are not a bug, but a feature of the global financial system. They are inbuilt and structural. They are the product of a system that routinely ascribes poor credit ratings to developing economies, starving them of private finance. Credit rating agencies are de facto decision makers in the global financial system. They should be accountable and transparent.